Are we live, Alex?
We are live.
We're live. Excellent. Well, good afternoon, all, and welcome to the spring model portfolio update from Momentum. I'm joined today by my erstwhile colleagues, Alex Harvey and Michael Clough. Good afternoon, gents.
Good afternoon.
Good afternoon. So Alex is lead portfolio manager for the managed portfolios. Michael Clough is fund analyst for the managed portfolios. So what are we going to look at today? Well, we're going to have a look at markets in general. We're going to have a look at how the managed portfolios have adapted and flexed to those markets. Then I think Michael's going to pick up in a little more detail fund selection and build up on some of the messages that he shared in our last update. And I think we've had a good run on the fund selection side, so more on that in a moment from Michael. And then right at the back end, we'll have an outlook and a look forward back from Alex. So first of all, without further ado, Alex, over to you.
Great. Thank you very much, and good afternoon, everyone. Fantastic. So, we're midway through May, 6 months on from Vaccine Monday, and exciting times, and portfolios have performed pretty well, actually. So I'll just kick off with a brief update on the market, touch on a couple of points, and then move forward from that. So I won't go through everything, but just some of these. I think that top left box is an important one because that's the real driver of market returns and risk and sentiment, I think, at the moment, and that's inflation. And not just here, but on the other side of the pond, as we say, in the US, which is driving global sentiment and global returns, and that has been surprising to the upside. You will have read about this kind of reflation trade, and rates have moved up with that. And we have had some inflation surprises, not least last week in the US. A big upside surprise. Somewhat expected. We know we're going to shoot to the upside, but it's a question of keeping that in check with market expectations. And at the moment, inflation expectations are creeping up. We had a huge move in rates in that first quarter, particularly through February and March, and it hasn't pulled back too much on equities. There has been a little bit of a break at the index level, but it's most sort of pronounced between this sort of value and growth, and we'll talk about that a little bit more. But needless to say, the sort of recovery in UK, or well, certainly in the UK, but the recovery in value stocks have performed well, and that's been one of the levers in the portfolio, which we'll touch on later. Against that, the vaccine news, COVID variants, amazing that after all this time, it still drives so much, but also amazing that in the 6 months since we just had a vaccine announced, such successful sort of vaccination rates here in the UK and other countries. But it is a two-tier vaccination market at the moment, and as we can see in some emerging markets, particularly in South America and India, that have been really afflicted, and that could end up being a sort of further drag on those economies and on emerging market stocks potentially sort of going forward. So it's quite bifurcated on the COVID and vaccine fronts. More domestically at home, we're emerging. As you know, yesterday the next wave of release and kind of we're ahead of Europe as well. Has gone pretty well, so that's all positive. And we're quite excited for the prospects for the UK relative to some of our trading partners, as well as in outright terms. Data's been pretty good as well. Sentiment is pretty much positive, maybe back a little bit from where it had been, but generally things notwithstanding the impact of COVID and the humanitarian side, but from the investment side and what we look at, we are moving through this recovery quite strongly. So thinking about the portfolios and changes that we've made and what we've done, I'm going to start off actually kind of sort of on the right hand side here and tell you what we've taken back a little bit and how we've recycled that. I think firstly at the top, we've got inflation-linked bonds. This is sort of very much in play actually. You can probably expect to see this come back a little bit further. We increased this in the middle of last year when they got really, really cheap. relative to nominal bonds. And that's been a really good trade in the portfolio. So we've been paring that back a little bit, and likely will continue to a bit. Convertibles, we made a lot of noise about this last year. Probably one of the best trades for 2020 for us, or for anyone, to be honest. But that had served its purpose to a degree, and the cohort inside that is more growthy as well. So and that is what has suffered a little bit with the rate backup that we've had in markets. So that's been quite timely when we brought that back in the beginning of the year. And the rest, in a sense, is a rotation away from sort of the more sort of quality equity side, which helped a lot through the worst months and times of 2020, and rotating that, as you can see on the left-hand side, a little bit more into the UK. It's a bit of a barbell there, some into the value of Schroder's value type strategy, and then the rest in sort of UK, more domestically exposed, and hopefully would benefit from the domestic recovery, moving on from Brexit, vaccine rollout moving well, all these good stories in the UK that at last can sort of like emerge a little bit. So that's largely the story there. Cash up a little bit, not too much in Fidelity, a bit of a sort of balancer on the equity side to keep the numbers largely neutral. With that, I did mention Schroder there. What I'll do is hand over to Michael, my colleague, who will put a bit of a spotlight around our manager work as well.
Thank you, Alex. And yeah, Alex mentioned there the rotation that we've seen over the last 6 months, and that's been very pronounced at the sector and market level, but it of course also feeds through into the underlying managers in the portfolios as well. And we're just trying to give a sense of the size of that rotation here. So here we show the return distribution of all the UK equity funds in the universe. So this is the UK all companies sector, the UK equity income, and the UK smaller companies sector, and we show the returns over the 5-year period to the end of October last year. So this is pre-vaccines, the vaccine news in early November, and you can see very much on the right-hand side are those quality and growth names, the likes of Lindsell Train and Evenlode on the quality side, and Jupiter and Lion Trust more on the small cap growth side of things. They were very much the leaders over the last few years or so, and you have Schroder Recovery there right at the other end. Schroder Recovery is very much a deeper value strategy, and found and performance struggled pre the vaccine news. Now fast forward on 6 months on the next slide, and we've seen just a massive rotation, and suddenly the names that were on the far left side of the previous chart are now all on the right hand side, and Schroder Recovery's bounced really strongly over the last 6 months. And sorry, I should say this is the same universe, so all those UK equity funds, but just in the 6 months to the end of April, and those value names are right at the top now, and it's those quality names like Evenlode, like Lindsell Train, that have lagged and are suddenly right at the back. So we've seen a big rotation, and on the next slide we just show a bit more detail on Schroder Recovery, which has been one of the top contributors over the last 6 months or so. We on the left hand side here we show the performance of the fund against the broad UK equity market in green, and the style benchmark, or the value benchmark, if you like, in yellow. And style benchmarks are very important to us when we're selecting active managers, as we do in the portfolios. So we've seen Schroder bounce really quite strongly, and on the right hand side just seek to show you kind of why that is and how that's happened. And And if we look at their positioning on the top right there, they're very much overweight the more cyclical parts of the market, the likes of the energy names like BP and Shell, and the banks like NatWest, Barclays, Standard Chartered, those types of names. And they're very much underweight the healthcare names and the consumer staples, those more defensive quality companies ultimately. And on the bottom right, we show the performance of those particular sectors over the last 6 months, and it's on a global basis, but it's very much the same story in the UK market. And we've seen banks and energy outperform quite sharply, upwards of kind of 30%-ish outperformance over the last 6 months, and it's been the healthcare and the staples names that have underperformed quite sharply. So that explains a lot of Schroder's outperformance over the last few months, and I guess the clue is partly in the name with Schroder Recovery. They're very much playing to that reopening trade, that reflation trade, as economies reopen up and recover from COVID. That plays very much into Schroder's hands, and if we continue to see that reflation trade continue, we should expect to see Schroder continue to perform well. And of course, the final point I'll say is we like Schroders in the portfolio today, but we certainly don't take all of our UK exposure through Schroders. We maintain a blend across the different investment styles in the portfolio. We continue to allocate to even load, to Jupiter and Lion Trust. So we remain broadly balanced in terms of investment styles, but Schroder has been very much the one leading the way over the last 6 months or so.
Right.
So with that, I will pass back to you, Alex.
Okay, thanks very much. Thank you for that update, and pleasing to see them having their moment in the spotlight as well, because it has been a tough time for value. So just thinking about some of the risk metrics in the portfolio before we look at the performance and the like. I just want people to know that there's two sides to these. What you think about the return, but we're very diligent about the risk in the portfolio. And what this shows, since Momentum have managed the portfolios since early 2016, or the range of portfolios, this is MPS 5, sort of representative in the middle of the range. And it shows the sort of bands, a 1 standard deviation band of what could be expected 2/3 of the time, being 1 standard deviation through time. That central blue line is the target, and the red line is what we've done. So we've always fallen within that zone, actually. So 100% of the time we've been where perhaps we could have been 2/3 of the time. We haven't fallen outside of that at all. So we've managed it tightly, and pleasingly 75% of the time above target as well, which if you work out on a sort of rolling basis over a sort of holding period, it's going to be a lot higher still. So even in the context of last year's drawdown, which was painful, but not outside the bounds of what one might expect if you hold the product over time. And diversification, crucial today. I wrote a blog just yesterday, actually, our weekly Global Matters, called Diversify for Diversifiers, which we'll touch on the next page. But this chart's really important, I think, because what it shows is the sort of basically the 3-month correlation between bonds and equities, and it's really risen a lot recently. And the reason for that is that when we have had equity pullbacks, or some softening in equity prices, not too big a pullback, but where they have softened, it's been the bond corrections that have caused it, and it's not bonds haven't been diversifying, but they've more been the cause of these equity pullbacks. It's that rate component in in sort of growth concentrated industries and sectors and indexes that have led equities a little bit lower. So it's really important not to put all your eggs in sort of one diversification basket today. And actually, I took this back to the beginning of 2000, and it briefly got a little bit higher twice, but it's basically around sort of the highs that that it has been at in the past. So we talk about diversifying your diversifiers. We've got a sort of template for a sort of a DT4 type risk rating on the right hand side, and these multiple layers, which we will have shown this before, the sort of concentric circles, the additional levers. We're not only multi-asset but multi-style and multi-manager. You get those 3 levers that build on each other and build in additional diversification. So as I said, versus 60-40, which just has the government bonds in there, which are expensive today, we are advocates of having a much broader blend of, some of these are not in their own right diversifiers. They're not absolute diversifiers. They're not going to go up when everything goes down, but when you put them together, they have a real diversification benefit. And what I showed is you can get on a DT4 rating a 70% improvement in the diversification benefits over a 60-40, just by broadening your asset allocation mix. So that's really important. We haven't changed anything there. We still have that style blend in the equity that Michael talked about, and we'll continue to do so. And that's really important in managing your equity risk and smoothing the journey. Then in terms of performance, coming on to that a little bit, I like this chart. This shows for the last 5 years, since we took on the mandates at the beginning of 2016, what the participation has been when the UK market has been up or down in any particular month by more than 1%. And what you can see is that our upside participation is that much higher than the downside. So, a little bit down, back up more, a little bit down, back up more. And that small incremental outperformance, which you compound over time, is where you get that smoother journey, and you get the outperformance from as well. So we're really pleased with that, and it's consistent across the profiles as well. Performance numbers here, lots of numbers on the charts. Don't need to go through them all. I think interesting just to note actually that in 2020, for one thing, all of the portfolios were positive, ended the years positive, which is pleasing, being diversified across different styles and asset classes. They did come back, they did perform well. 2018 was a down year, but which was worse than 2020 in market performance, partly because Q4 2018 was a shocker, so timing is part of that. Nonetheless, they finished the year positive. Nearer term performance in 12 months is fantastic, very pleased with that. Again, it's sort of base year-on-year effects. But looking at the 3-year and since inception, which are somewhat close, but they're sort of like 0.5 to 1 point, maybe a little bit behind their outcomes at the moment. But it doesn't take too much. A little bit of progression in equity bourses, 4 or 5%, 3% in the 3-year number case, and you'll be on target there. So a little bit short, but close. And as I said, when we looked at that risk funnel, kind of in the profile that we would expect to see. And of course, this is all net of fees as well. So that's pleasing. This is broadly similar, but we just have a 5-year number, and we put this out at the beginning of the year, or earlier in the year when we hit our sort of 5 years. I think the point I probably want to make, we've highlighted at the bottom there where the MSCI UK index is, and that over 5 years annualized and cumulative, obviously, therefore all of the range, even the lower risk range, has outperformed a 100% UK index, partly because we have overseas exposure and multi-asset, etc., and the like. But for clients based in the UK, that should be a pleasing outcome to get more than equity returns with substantially less than domestic equity risk. And the de facto rating as well, which is pleasing. We've got the 5 stars, 5 diamonds there, which we're very pleased with. Tactical views and positioning. Just touch on that for a little bit in the last sort of 5 minutes or so. These do change around a little bit, but suffice to say really that sort of on the back of the views I expressed in the first slide, really. We are quite favourable on the UK at the moment, within UK equities in particular. Our exposure is roughly equal to global equities, pretty much. I mean, if that was a global weighted, then we'd be heavily overweight the UK, but we own about sort of 50-50 between the UK and global. And that is, that's really sort of fired up in the last 6 months. Obviously, the UK has a natural sort of value bias, given the makeup of companies, energy names, banks, and that Brexit discount that has been sitting there. And the UK still is at a discount. So even though we've had some great performance, we think there's a lot more to come. So we continue to favour the UK. Japanese equities, we're actually looking at the moment and doing a little bit of work around there. Potentially may add a little bit. Quite liking, actually, as well as the Japanese market in its own right, and the relative performance, which has been a little bit disappointing versus other global markets. So we see it as a bit of an opportunity to catch up potentially. But it also comes with Japanese yen exposure if we do it unhedged. And the yen has been pretty weak year to date. It has sold off, unsurprisingly perhaps, from the risk on sentiment. And the yen is a diversifying currency. So that is there's a double reason really to buy there. One for the attraction of the Japanese market, and another for the currency. And emerging market equities, it's a very idiosyncratic market. Difficult to talk about the broad asset class, but we think valuations remain attractive over the longer term, and in a global recovery, notwithstanding local issues and headwinds and challenges, particularly around sort of COVID at the moment. We think over time, as economies, global economy recovers, emerging markets should benefit from that as well, and share in that. And with the cheap valuation, we think that's a better longer term opportunity. Fixed income, no greens there. Not too much that's really grabbing our fancy today. Convertibles would have been last year, and some of the credit. Pretty much all of that has been scaled back largely. That low-hanging fruit went fairly quickly. I don't have a real issue with credit at the moment, but it's a bit more of a carry opportunity really, and a carry trade. Don't see too much upside there at the moment, really. Hence it being amber. But the more rate sensitive markets, governments, index linked, investment grades, we are overall sort of underweight in duration terms. We do still own some government bonds, mostly US Treasuries actually, which are hedged into sterling, and TIPS as well, or global inflation linked bonds, with the backdrop of inflation. But in absolute terms, not all that attractive today. And as I said, we find diversifiers in other parts of the portfolio, such as liquid alternatives, infrastructure. Those liquid alternatives, they try to be uncorrelated to the market, non-directional, and make a sort of 3 to 5% return per annum over time. That's kind of the idea. We use Neuberger Berman as part of that portfolio, and we've spoken about them before. And infrastructure, which we're very favourable on at the moment, given the backdrop that we've heard from governments around the world, not least in the US, to pump money into infrastructure spending and stimulus programs, which should ultimately sort of be the beneficiaries of those programs. Currency-wise, not too much to say. I did talk a little bit about the yen. I could probably upgrade that a bit, but by and large, that is covered. Positioning. This will be in the pack, which you'll be able to see. But suffice to say, infrastructure, real assets at the upper end. The equity I spoke about, global equity, UK equity, fairly balanced. Strategic bonds at the lower end of the range today. Convertibles have come back as well, and cash sort of middling. Not too much to talk to, I don't think. There, in risk terms, the portfolio remains reasonably risk on versus the DT target range today. A lot of the outlook, I've kind of covered. I think the main points here is that we think, notwithstanding any sort of changes that may come through, but we're constructive on risk. We think that setbacks in equity indexes that may be on the back of rate rises, for example. It could be rate rises are for the right reasons ultimately, and it is a positive backdrop to growth, and we would potentially use that an opportunity to add. I've talked about the UK exposure, the underweight duration. I think the main point in that top session is to be diversified. You've got to be diversified. Just don't rely on bonds today. And that style blend is a really important point, which we've spoken to on calls before. Not too much to add to that. We hope that the cyclical names and sectors continue to perform. They've had a really good sort of 6 months. We're not all in on those. That's part of our blend. But if that continues, and with the UK bias and with some of the underperformance we had in the past from the likes of Schroders, that should be a really good tailwind to portfolio returns. So with that, I'll wrap up that investment side of things and hand back to Steve.
Thanks, Alex, and thanks, Alex and Michael, for the update there. We don't have the ability to take questions today, hoping to get that infrastructure in place for our next quarterly update. But needless to say, if you'd like to know more, or you have any questions, then please don't hesitate to get in touch. My email's up on the slide there. And I guess in summary, really pleasing, nice steady performance from the portfolios over the quarter. And as Michael and Alex indeed alluded to, it's good to see that style blend and the fact that we have value in the portfolio aligned with growth and quality really coming to the fore in the last few months. So all that remains, if Alex can just page forward. Got to have the compliance slide, Alex. Got to have the compliance slide in. All that remains is for me to just thank Alex and Michael, thank our listeners today, and I do hope you have an enjoyable rest of the day and an enjoyable rest of the week. Thank you very much for your time. That concludes our update today.
Thank you.
Thanks, everyone.